Okay, so moving on, we're now looking at dividends and share repurchases, and we're just going to have a look at some basics, really. Some of these concepts you should probably be familiar with already. So let's start off, we start off describing the different types of dividends. So presumably you're all happy with what a dividend is, with what a cash dividend is. It's a payment made to shareholders in cash, so it's distributing some profits. There are three types of dividends. So we've got our regular dividends, which is what you would have seen so far, so distributing profits to the shareholders in the form of cash. Ideally, we'd like to see this dividend maybe growing year on year. We might have a special dividend, so a special one-off dividend. Maybe we've just got, I don't know, we disposed of part of the business during the year and we've now got a load of cash sitting on the balance sheet. We don't really have anything to invest it in and therefore we return it to the shareholders. And then finally, I guess this is probably your worst case scenario, a liquidating dividend. Either we've gone bust or we've shut the business down, we've liquidated all the assets, and therefore if there's any money left, then some cash will go back to the shareholders. That will be your liquidating dividend. Okay, so alternatively, if we don't have cash to pay a dividend, we might just offer a stock dividend whereby we pay our shareholders in shares of stock as opposed to cash. So 10% of existing shares will pay out as a stock dividend. We might do a stock split. What is a stock split? Well, a stock split is, let's say we have one share out there that is worth 100. Well, what we'll do is we'll give our shareholder another share. So instead of having one share worth 100, they now have two shares worth 50 each. Why would we do that? And you tend to see this a lot in the UK. Why would we do that? It's to increase the marketability and to increase the liquidity of our shares. By decreasing the price, we're hoping people are going to trade them more. Now, why is that? Never underestimate the role behavioural psychology plays in the market. If you have a look on the London Stock Exchange and you look at the shares listed on the London Stock Exchange, most shares tend to be below £10. When we talk about share prices over here, we talk in terms of pence. We talk, it's 350p, it's 500p. And I guess that's because, I don't know, us Brits, we're a little bit tight. We don't like spending money. And so once share prices go above £10, then we freak out. £10? £10? No, too expensive. I'm not going to buy. And so we don't buy. So in order to increase liquidity, because the market's not going to be very efficient if no one's trading, because we all think the share price is too expensive, we just issue more shares. And by issuing more shares, we're reducing the share price. So you've got one share worth 100, here's another share, you now have two shares worth 50 each. That is now more liquid. So the key point there is, just because we've given our shareholders more shares, the value of the company hasn't changed. We haven't raised any cash by doing this. So the value of the company hasn't changed. We've just got more shares, therefore the share price is slightly lower. The opposite of that would be a reverse stock split or a stock consolidation, whereby we take shares away from you. You have two shares worth 50 each. We're going to take one away from you. You're left with one share worth 100. So why are we doing this? We're doing this to increase the share price. And you might see that more so in America, because in America, well, bigger is better, right? So the higher the share price, the more, the better the company must be. That's the perception over there. So when you look at the shares listed on the New York Stock Exchange, a lot of them are trading in hundreds of dollars. We don't talk about shares trading in cents over there in the same way we talk about them trading in pence in the UK. So we might see some reverse stock splits over in the US. The key point, all these three, we're just giving shares to our shareholders, or we're taking shares away. There is no change of cash here, and therefore none of these transactions, oh, here we go again, I've lost my pen. None of these transactions change the value of the company and therefore the value of the total stock outstanding. So let's have a look at the effect of these dividends on our ratios. Well, if I'm paying a cash dividend, then clearly my cash is affected. And if my cash is affected, then my assets are affected. So cash goes down, assets go down. And then the other side of that, remember, dividends are paid out of retained earnings. And retained earnings sits within equity. So cash down, equity down, or assets down, equity down, my balance sheet is still balancing. So how does this affect my ratios? Well, remember from accounting, your liquidity ratios classic liquidity ratio. We'll actually see some more of these when we do the working capital management reading. But if we look at current assets over current liabilities, well, if I pay a cash dividend, my cash goes down, so my current assets go down. Nothing happens to my current liabilities, so overall this ratio decreases. So your liquidity ratios decrease if you pay a cash dividend. What about your leverage ratios? If we look at debt over assets as an example of a leverage ratio, again, paying a dividend has no effect on my debt number. However, my cash has gone down, therefore my assets have gone down. So if my denominator is going down, then overall this ratio is increasing. So my leverage ratios actually increase when I pay a cash dividend. Stock dividends, stock splits, no impact on the value of the company, no change in cash, therefore do not affect my liquidity ratios or my leverage ratios. Okay, you do need to be able to describe dividend payment procedures. So let's just run through this timeline and see what happens. So on August 25th, the board declare a dividend. So the minute they declare a dividend, they announce they're going to pay a dividend. They need to record that dividend in their balance sheet. And what we should see starting to happen to the share price is that the share price will rise in anticipation of that dividend. Now, at some point in time, that dividend or that share is going to go ex-div. And what does ex-div mean? It means if you buy the share on this date, then you will not get that dividend. So if we work backwards, let's imagine September 17th is a Friday. This is the holder of record date. This is the date that the company secretary will have a look at the register and look at who the shareholders are on that date. And if your name is on the register, then you will get the dividend. Now, in the US, shares settle T+3. So it will take 3 days from the trade date for your name to end up on that register. So can you see, if I buy the share on, let's say Tuesday, if I buy a share on Tuesday, then we've got Wednesday, Thursday, Friday, T+3. I will be on the register on Friday. So when the company secretary looks at the shareholders register, my name's there, I will get the dividend. But if I buy the share on the Wednesday, when am I going to appear in the shareholders register? We've got Thursday, Friday, and then we've got the weekend. So I'm not going to appear in the register until the following Monday. So when the company secretary is looking at the register of Friday, my name isn't on there. Okay, it's the seller's name that's still in there. Hence, we call that the ex-div date. If you buy the share on the Wednesday or after, you will not get the dividend because you are not on the register on the holder of record date. And therefore, this share is less valuable to you. The share price should, in theory, drop by the value of the dividend to reflect the fact that we're not going to receive this dividend. So typically, then, if it's September 15th and 2 days later is when, if I go ex-div on September 15th and 2 days later, that's my holder of record date. And then at some point thereafter, generally within about 30 days, the dividend will actually be paid. Okay, so that's that process there. What if the company wanted to buy back its own shares? Then what are the various ways it could do so? Well, we could just go out into the market and buy back our shares at whatever the market price happens to be at that point in time. Advantage of that, we have flexibility. We can go into the market whenever we like. A tender offer is when we make an offer to all shareholders. So we're basically saying we need to buy a fixed number of shares and this is the price we're willing to pay. Typically, we're going to have to make that offer at a slight premium to the market price to encourage these investors to sell their shares back to us. So we are paying a little bit of a premium. Or alternatively, we can just directly negotiate with one big shareholder. So let's imagine Warren Buffett happens to be a big shareholder in our company. We could just go direct to him, so not make this offer to everyone and say to Warren Buffett, look, we need to buy back some shares. We'll pay you a slight premium if you sell them back to us, okay? So that's not really great for the remaining shareholders, that last one. Okay, why would we want to do a share repurchase? If you think about it, a share repurchase is simply just returning money to the shareholders. So it's just like one big dividend. So why might a company choose to do a share repurchase as opposed to just pay a large dividend? Well, here we go. Rationales for share repurchase instead of cash dividend. Maybe because of tax advantages. If we do a share repurchase, then we're buying the shares back. So from the investor's point of view, that's a capital gain. And their capital gains tax rate may be lower than the income tax rate, which is what they normally pay on dividends. Or it could be there's capital gains allowances that they haven't used up for the year, so they don't pay any tax on it. So it could be a tax advantage to the investors, and so we do it to keep our investors happy. It could be the alternative method, the alternative reason why we might want to do a share repurchase is we're trying to send a signal to the market. We believe our shares are undervalued and therefore we're investing in our own shares. So we're trying to send a signal out. What we'll see later on, that assuming there are no tax advantages and assuming we're not trying to send any signal to the market, then actually the effect on the shareholders is the same, whether we call it a dividend or a share repurchase. The wealth of the shareholders doesn't change based on whether it's a dividend or a share repurchase. So we'll have a look at that. We've got an example coming up. But before we get there, let's have a look at what a share repurchase does to our earnings per share. Now, instinctively, you might think, okay, we're doing a share repurchase, therefore we are reducing the number of outstanding shares, therefore our earnings per share should increase because we're taking our earnings and we're dividing by a smaller number of shares. Not necessarily. It depends how we're financing that share repurchase. If we are borrowing money to fund the share repurchase, then we are going to incur interest on those borrowed funds. And if the interest costs more than offset what we are saving by buying back, the shares, so the drop in our shares, then we might actually end up with an EPS that's lower than it was before. So let's have a look at an example. So we're told here we've got the price is $50 per share. We've got 50,000 shares outstanding. The current EPS is $4 per share, and the after-tax cost of funds is 10%. So that's the interest cost on our debt, if you like, after tax. And we're going to buy back 5,000 shares. So what is our total interest cost that would be in our income statement? Well, we've got 5,000 shares that we're trying to buy back at $50. So in total, we're trying to raise $250,000 to repurchase those shares. So we need 250,000. And on that 250,000 that I've borrowed, I'm paying 10% interest. So my total interest cost is 25,000. So that's going to come out of my earnings. So my earnings were $4 per share. So there's your $4. We've got 50,000 shares. So that's your total earnings. And then we're going to knock off that, the $25,000 interest that's now going to come out of my profits as well, to get our new earnings, taking into account the interest, divided by the new number of shares. So 45,000 shares, because we've now repurchased 5,000 of them. And that gets us down to $3.89. So can you see that share repurchase has actually resulted in my earnings per share number dropping. Now, why is that? It's actually a quick way. I could have told you that that was going to happen without doing all of this maths. All you have to do is compare the cost of funds, so the interest, to the earnings yield. Now, if you ever see the word yield, just divide by price. So if it's dividend yield, it's dividend over price. If it's coupon yield, it's coupon over price. If it's earnings yield, then it's earnings over price. So our earnings yield is, earnings were $4 per share and the share price is 50. So my earnings yield was 8%. So what this is telling me, the way to interpret this, is it's costing me 10% to raise the funds to buy back the shares, which is saving me a yield of 8%. So it's costing me more to buy the shares back than what I'm saving by not having those shares out there. That is a bad thing, therefore my EPS drops. If it was the other way round, and let's say this was 6%, well then it's costing me 6% to buy back shares to therefore save 8%. That is a good thing for shareholders, therefore the EPS will go up. Okay, so that's a nice little rule to remember. When the after-tax cost of funds is greater than the earnings yield, your EPS falls, and vice versa. Similarly, we can have a look at the effect a share repurchase has on the book value per share. So using the same numbers, price $50 per share, 50,000 shares outstanding, book value per share is $40. So when we originally issued these shares, they were issued at $40. That's what we've got on our balance sheet. And we're again buying back 5,000 shares. So how much am I buying back? The 5,000 shares at $50 each. So there's the $250,000 that we saw earlier. My original equity, I've got 50,000 shares at 40 of 2 million. That's what I've got on my balance sheet. What's my new book value per share? Well, I've got the 2 million, knock off the 250,000, which is the cost of buying back 5,000 shares, divided by the new number of shares, which is 45,000. So you get a new book value per share of 38.89. Again, it's not surprising that that number has dropped. I'm paying more to buy back the shares than I had originally issued them at. I'd originally issued them at 40. I'm buying them back for 50. That's going to result in a decrease in my book value per share. So when the share price is greater than the book value, a repurchase will decrease the book value per share, and vice versa. Okay, this is the point that I made earlier. From an investor's point of view, whether it's a share repurchase or a cash dividend, as long as the tax treatment is the same, so there's no advantage to me having a capital gain as opposed to paying income tax, and as long as we're not trying to send a signal to the market, so information effects are the same, then actually the effects of a cash dividend or an equal value share repurchase are exactly the same. And we've got a little numbers example here that proves that to you. So we're starting off with a stock price of $30. We've got 10,000 shares outstanding. We're going to pay a cash dividend of $3 per share. So $3 times 10,000 shares, that's $30,000 in total. The value of the company, therefore, is going to drop by 30,000 because we've got 30,000 less cash in total, or $3 per share. So stock price was originally 30, less the $3 dividend that's just been paid. So the share price is now going to be $27. We've still got 10,000 shares outstanding. They're just now worth $27 each, and therefore the market value of the equity is $270,000. If instead of paying a cash dividend, I chose to repurchase 1,000 shares for a total of $30,000, so it's a total, in total the cash amount is the same, then my shares outstanding decreased to 9,000. So I've now got 9,000 shares outstanding. They're still worth $30 each. Again, that equals $270,000. So as long as there is no tax advantage to one or the other, as long as there is no information signal that we are trying to send out, then the value of the equity should be the same. Okay, and that's it.